Hello and welcome back to Game of Trades, your number one channel for videos on the stock market and cryptocurrencies. This is going to be an exceptionally important episode because we're going to be discussing two important topics, and hopefully by the end of this video you'll have a deeper understanding of, first of all, how the bond market could actually trigger the beginning of the next bear market and the exact reasons behind that thesis. And secondly, whether that's something that we should be worried about today. And we're going to take a look under the hood in the market right now, see what's happening on a deeper level within the sectors, within the bond market, and see exactly what we should be preparing for. If you're interested in following these crazy markets with us, make sure to click on that subscribe button. We give our opinions on the stock market and where we think that this massive equity bull run that we've seen since 2009, where we think it's going. We look at the data and the research every week to see how we should be positioning, whether that's long or short. Now, without further ado, let's get right into it. Now here, I want to begin this video by taking a look at this chart here and hopefully putting into context what's been driving the bull market since 2009. This is a chart of the technology sector divided by the SP500. So it shows you the performance of the tech sector relative to the rest of the market. And you can see, of course, it's no secret to anyone that technology has been the outperformer. Technology, in fact, has been pushing the markets higher since 2002 and in a much more aggressive way recently since 2018. And you may ask, why is that? And my favorite answer to that question is that the macro environment has been favorable to technology stocks outperforming. That has been a steady long-term decline in bond yields. As bond yields go down, growth stocks and technology stocks tend to outperform. They tend to do well. And you can clearly see periods where bond yields are rising tends to correspond with periods where the technology sector is underperforming, and vice versa. When bond yields are falling, the tech sector tends to outperform. This has been especially true here throughout 2019 and 2020. We've seen almost a perfect inverse relationship between the performance of technology and bond yield. And since bond yields have been incredibly low here, they went down all the way to 0.5% during the COVID-19 crisis, it really triggered a massive run in technology throughout 2019 and 2020. And since we've had that bottom in yields and we've seen yields begin to trend up, we've seen that big move up in technology really slow down, right? You can see that the rate of ascension in technology has not been the same as it was back in 2019. Now, if the bull market that we've seen since 2009 has primarily been fueled by an outperformance in technology, which has been fueled by falling yields, well, maybe the current environment that we're seeing with high inflation and rising bond yields might actually eventually kill the bull market. In fact, if I add a 100-week moving average on this chart, you can see it's very interesting. We've always seen the technology sector bounce off that moving average without fail right here, and it's testing that moving average right now. I think that this is a very good indicator of momentum in the market. If we eventually see this chart break to the downside, then that's telling us, hold on, what's been driving the bull market since 2009, the tech sector that's built so much momentum to the upside, all of a sudden the momentum's to the downside. And I think that could actually trigger some pretty important drawdowns once that momentum switches. So that's the first part of this video, the big context behind the technology sector. I think if we continue to see rising yields very aggressively rising yields, we could start to see this momentum shift to the downside. You could start to see some type of a big topping pattern on this chart here. In fact, you can see it's already starting to look like a wedge pattern. Now here's where I'm going to be diving a little bit more short term and take a look at the second part of this video, which is whether or not we should be worried about that type of breakdown now. By the way, if you're so far enjoying this video, do not forget to click on that like button. It really makes all the effort and all the time that we take to make this research and plan out these videos, it all makes it worthwhile if you take those couple of seconds to hit that gray thumb. It is truly appreciated. Now, in order to take a look at the short-term stuff, I want to take you back to a video that I posted here. Investors are extremely badly positioned for this next big SP 500 move. In this video, we took a look at this chart here that showed that fund managers were actually all positioned for yields to rise. And so they were heavily positioned in banks that tend to perform well when yields are rising. And they were underweight in bonds and technology, because when yields are rising, it means bonds are falling. And tech, as we just discussed, underperforms when yields are rising. So we took a look at this and we actually said, well, this is the opposite of what we are expecting. We're actually expecting bonds to rise, and that would put pressure on yields, and that would be good for technology. So let's see what's happened since. Indeed, if we take a look at TLT, it's been starting a nice run here. And so that's been pushing yields down. You can see this is the 10-year yield. It's broken down here. So you can see we're back to that chart of the tech sector divided by the SP 500. Everything that's been driving the tech sector down here, which has been rising yields, all of a sudden we're getting that shift in momentum in those yields, but we haven't had that turnaround in the technology sector. So I think that's going to happen very soon as we continue this consolidation on yields, which forces the technology sector back up. So if I had to make a quick summary of what I want to say, every time this chart tests support, if yields are falling, it's going to bounce. You can see I'm going to add the 10-year yield on this chart here. You can see right here, yields were falling as this chart was testing support, so it bounced. Right here, tech tests support, yields are falling, and so it bounces. Here, testing support, yields are falling, bounces. Here, testing support, and yields are beginning to fall. So I think that's a nice setup for somewhere around this week for a nice bounce on the technology sector, and so a nice recovery on the market. Now, unfortunately, although I do think yields are coming down in the short term, I don't think this is going to last very long. If you took a look at our last few premium posts, we discussed it briefly on our Game of Trades ratings across asset classes and on this premium video on economic growth and inflation. Inflationary pressures are continuing to build, right? We've got record wages, inventory rebuilding that's set to accelerate in 2022, Omicron reopening. I think that's going to lead to some pretty hot inflationary readings throughout 2022, and that's going to fuel higher yields. That's what happens when you've got inflation. So although I think technology is going to perform pretty well over the next few weeks, few months, once that trend begins to re-accelerate, that's when technology could get hit pretty bad. I mean, once we start to flirt with the upper end of this range, if we reach 2.5% on the 10-year yield, that would start to trigger some pretty tough downside on the technology sector and would finally make this trend and this momentum that we've seen for the past decade break. And that's why one of the big focus points of our research, analysis, and articles that we post on gameoftrades.net are on other assets. For example, gold, precious metals have been one of the big focus points behind our long-term investment strategy, completely uncorrelated to the market. In fact, pretty much inversely correlated to the equity markets. And of course, gold has been on an absolute run recently. Of course, with the Russian invasion of Ukraine throughout the past few weeks, but that's not what our long-term bullish case is based on for gold. We have an entire macro strategy corner on our website covering why we believe gold is going to be heading much, much higher throughout the decade. We've been posting articles on accumulation opportunities this entire period. I do think there will be more opportunities to load up on gold. I think this is really one of the things that really differentiates our investment research and convictions from other services, is that we are looking to explore any opportunity that we think is going to outperform, especially looking out in the long run. And gold is definitely one of those opportunities that I think many financial institutions aren't even looking at, aren't even considering as an option, because it's not a core part of the financial system. And yet history shows us that in macro environments like we have today, you look across nations, across empires throughout the past 500 years, gold has made some people become incredibly wealthy. So if you're interested in following that with us, make sure to click on the link down below. There's a free trial to our service. You can check out some of the articles that we already have on all of the assets and all the opportunities that we look at. And of course, tune in for the many articles and many opportunities that we'll be posting on the website over the course of the next few months. Now, that's about all I wanted to cover in this episode. I hope you guys enjoyed. If you did, make sure to click on that like button and subscribe if you haven't already. Now, in the meantime, I wish you good luck on your trading and see you next time.